Warren Buffett once famously said, "Investment in knowledge pays the best interest." And when it comes to the world of finance, dividend investing is one of the smartest strategies that can yield massive rewards. If you're a beginner looking for a step-by-step guide from knowledge to real-life examples, you've come to the right place. In the next few minutes, I'm going to walk you through the essentials of dividend investing. We'll explore what dividend stocks are and how they can benefit you. But that's just the tip of the iceberg. I'll discuss different strategies you can adopt in dividend investing, whether it's focusing on growth, capturing dividends, or reinvesting your earnings. You'll have a strategy that suits your goals. I'll guide you through the step-by-step process of starting your own dividend portfolio, from choosing the right brokerage account and setting up a broker account to selecting the best dividend stocks that have the potential to make you a millionaire. In the end, we'll show you stocks that have the potential to pay over $50,000 in annual dividends with only $10,000 of initial investment. Remember, this is not a sprint, but a marathon. Building wealth through dividends takes time and patience. So stay tuned, grab a notebook, and let's start on this financial adventure together. Let's start by understanding what dividend investing is all about. Dividend stocks are an exciting aspect of the stock market, providing investors with a unique opportunity to earn from their investments. Simply put, a dividend stock in general represents a share in a company that pays out a portion of its earnings to its shareholders. These payouts are known as dividends. Generally, companies that offer dividend stocks are well-established and financially stable with a consistent record of sharing profits with their investors. To understand how dividend stocks work, let's consider a simple example. Imagine you buy 100 shares of a company, with each share priced at $10. This means your total investment is $1,000. Now, suppose this company pays 50 cents in dividends per share annually. Owning 100 shares, you'd receive a total dividend of $50 for that year. This equals a dividend yield of 5% on your investment. So, in essence, you're earning a passive income of $50 simply by holding these shares. The benefits of having dividend stocks are multiple. Firstly, it provides a regular income stream. Unlike investing in stocks solely for price appreciation, which can fluctuate unpredictably, dividends offer a more stable and predictable return. This makes dividend investing particularly appealing to those seeking a steady income, like retirees. Also, on the plus side, dividend investing can be less risky compared to other types of stock investments. Since dividend stocks are often from established companies, they tend to be less volatile in the stock market. Moreover, passive income from dividends can be a reliable source of cash flow, especially during economic downturns when the stock prices may fall. Now that you know what dividends are, you need to set goals for your stock investment. When starting on your journey in dividend investing, the first critical step is to clearly define your financial goals and understand your risk tolerance. Each investor's goals are unique and can range from building a retirement fund to generating a steady stream of income. For instance, if your goal is to create a safety net for the future, you might lean towards a more conservative approach, focusing on stocks with stable dividends. On the other hand, if you aim to accumulate wealth over time, you might opt for stocks with the potential for both dividends and capital appreciation. Understanding your risk tolerance is equally crucial. This simply means how much risk you're comfortable taking on. If the thought of your investments fluctuating in value makes you anxious, you likely have a low risk tolerance and might prefer investing in well-established companies with a consistent dividend-paying history. Likewise, if you're comfortable with some level of risk for the chance of higher returns, you might diversify into some growth-oriented dividend stocks. Speaking of which, diversification, in simple words, means not putting all of your eggs in one basket. It's about spreading your investments across various sectors and companies to minimize risks. While I will dive deeper into the importance of diversification in the upcoming chapters on how you can earn good dividends and also gain from capital appreciation of your investment, It's crucial to understand that a well-diversified portfolio can help shield you from market volatility and specific sector downturns. Now that you've set a goal, you need a strategy to reach that goal. This will determine how much investment you would need to invest in particular stocks. In the coming chapter, I'll show you how I research stocks for my portfolio and the metrics I look for investment using a broker. And also, in the end, I'll show you stocks that can make you a millionaire and pay over $50,000 in dividends. So stay tuned for that. Now, back to the strategies. When it comes to strategies in dividend investing, you have the option to think long-term or short-term. Short-term investing generally requires a significant amount of capital to make substantial gains in a shorter period. However, it also comes with higher risks and the need for constant market analysis. This means that if you have a high risk tolerance mindset, you're more likely to opt for this strategy. That is, your goal is capital appreciation and you want to achieve it in the short term. So your strategy might involve choosing stocks whose prices are likely to rise in the short term and gaining capital appreciation from that. However, this also means you have to invest a significant portion up front. Let's say you want to use the short-term strategy in dividend investing. If you want to invest $1,000 and invest in a stock that grows by 10% on average each year, your investment would increase by $100 in the first year, making your total $1,100. This is good, a 10% return, but again, it's only $100 in 1 year. So if you want to earn close to, let's say, $10,000 from the same stock, you have to invest around $100,000 in starting investment. And this figure will only go up if you've set a higher goal. On the other hand, dividend stocks also give you a second option in the form of long-term investment, which can be more accessible and less stressful. For example, with an initial investment of $10,000 in a diverse range of dividend stocks and a strategy focused on companies with a history of stable and growing dividends, you can start building a solid portfolio. This approach might not give you immediate large returns, but it's about growing your wealth steadily and sustainably. Let me provide you with some numbers. Let's say you invest in a stock that pays a dividend yield of 4% and has a dividend growth rate of 5% per year. If you invest in this stock and wait for 30 years, reinvesting the dividends paid by the company, by the end of those 30 years, your investment portfolio will be valued at $125,463, paying an annual dividend of $17,737. So you've achieved the same, or in this case, even better results than a short-term strategy with only a $10,000 investment. What can make a long-term strategy even more effective is the power of compounding. If you were to add a monthly contribution of just $100 to your investment, this consistent addition not only boosts your investment amount over time, but also allows you to purchase more shares, which can lead to more dividends. This strategy of reinvesting dividends and adding a small regular contribution can significantly add to the growth of your portfolio over the years. Referencing the above example, with a $100 monthly contribution, after 30 years, your portfolio will be valued at $330,702, paying an annual dividend of $46,582. That's an extra $200,000 in profit compared to our first example, even though you would only contribute $36,000 in monthly contributions over 30 years. And to top it off, it's not too stressful on your wallet. And that's why on this channel, I focus on more long-term investment options so that everyone can start with even a small budget. You might have a different strategy and goal, but that's totally up to how you want to reach the common end goal of making a profit. But one thing that both strategies need is to take the next step and select the right broker platform, because your dividend investing journey begins with selecting the right brokerage platform. For today's video and our step-by-step beginner's guide, I'm teaming up with the brokerage service Moomoo.
Special thanks to Moomoo for sponsoring this video. They've been following us, and as a mutual benefit deal, they've generously offered 15 free stocks to anyone signing up through this partnership. It's an incredible opportunity because it'll give you exposure to the stock market with no risk. With this offer, you can even sell the free stocks you receive, make a profit, and withdraw it to your checking account, essentially earning money in the stock market without any initial risk. But please note that you need to hold the money for 60 days before withdrawing in order to earn these returns. Now, you might be wondering why I've chosen Moomoo and if it's a safe platform. Look, I get it. The name can be a bit amusing, but let me clarify what Moomoo is, because it's more than just a brokerage. It's an app that allows you to trade stocks, options, and ETFs from your laptop, iPad, or your phone. What sets Moomoo apart is that they don't charge any commission fees, unlike some other brokerages that do. They're also a member of the SEC, FINRA, and SIPC, which means Moomoo users are insured up to $500,000 in their accounts. Regarding the app itself, whether you're on a computer or phone, it has a user-friendly interface. To top it off, Moomoo sweetens the deal with an impressive 5.1% APY, plus an additional 3% APY interest valid for 3 months on your uninvested cash in the US. New eligible users can enjoy a total interest rate of 8.1%, and that's not just limited to the US. In the Australian market, Moomoo also offers a competitive 6.8% interest rate. So even if you're not actively investing, you can still earn some extra income. But it doesn't stop there. If you're a new user, you can get up to 15 free stocks with signups in the US. Now, to get started and take advantage of these offers, use the link in the description below the like button. Signing up for Moomoo is a straightforward process. First, you need to click the link in the description of this video. It will take you to the registration page. On the registration page, you'll be guided through a simple registration process requiring basic personal information and identity verification. Once your account is set up, depositing money is just as easy. Connect your bank account to transfer funds securely into your Moomoo account. With your account funded, you're now ready to start exploring investment options and diving into the world of trading and dividend investing. Now that you have a trading app, let's begin with dividend investing. Getting started with dividend investing is an exciting phase as you begin to build your portfolio. One of the first steps is finding dividend-paying stocks. Before you start investing in dividend stocks, here are a few final tips to keep in mind. Dividend investing is not about quick gains. Rather, it's a strategy for steady growth over time. For instance, if you invest in a company with a strong track record of paying dividends, the real value comes from holding on to that investment for many years. Over time, not only do you benefit from the ongoing dividends, but you also stand to gain from the potential appreciation in the stock price. It's like planting a tree. The true reward comes from nurturing it and watching it grow over the years. Remember, there's also a downside to holding stocks for many years. A stock that's doing fine today might be overtaken by its competitors, which can result in a drop in share price and dividends. Another vital concept to grasp is how dividend investing can help you navigate market fluctuations and bear markets. When the market is volatile, stock prices can fluctuate wildly, but dividends tend to be more stable. So, if you're a beginner, I highly recommend looking into the Dividend Aristocrats or Dividend Kings category of stocks. These are the stocks that have paid and consistently increased their dividends for over 25 and 50 years respectively. This approach will save you the hassle of sifting through a massive number of stocks, which in some cases can be over 2,000. Now, when you start with Dividend Aristocrats or Kings, you'll still have around 80 stocks to choose from. To keep it simple, you need to keep an eye on the following 4 metrics to make an informed decision. These are dividend payout ratio, dividend coverage ratio, free cash flow to equity, net debt to EBITDA ratio. Here's why these metrics are important. The dividend payout ratio tells us how much of a company's profits are used to pay dividends.
If it's less than 50%, that's usually a sign of stability, and the company may have the potential to increase its earnings over time. Anything over 70% is considered risky territory because it leaves too little for the company to reinvest and grow over time. Next is the dividend coverage ratio, which measures how many times a company can pay dividends using its profits. A higher number is better because it means the company can easily cover its current and future dividend payments. Then there's free cash flow to equity, which in simple words is the money left for shareholders after all the bills are paid. It's essential that a company can fully cover its dividend payments with this money. And the last one, net debt to EBITDA ratio, checks if a company has too much debt compared to its earnings. It's better if this ratio is lower than similar companies. If it keeps going up, it might be a sign that the company could have trouble paying dividends in the future. So these metrics help us make informed decisions about which dividend stocks to invest in. And lastly, there's the dividend yield itself. Don't get tempted by a stock with a very high dividend yield. Personally, I set a limit of not going beyond a 10% current dividend yield for long-term investments. This is because in the long run, the current dividend yield doesn't matter much. It depends a lot on the dividend growth rate dividends. I'll explain that when we go into the details of finalizing the stock selection process. To avoid falling into a dividend trap, you should look beyond just the high yield. For example, if a company's stock price recently dropped a lot, its dividend yield might look very high, but it's not necessarily a good investment. The drop in stock price could be a warning sign that the company's facing problems, and there's a risk they might reduce their dividend payments in the future. The next step is choosing and finalizing the dividend stocks for your portfolio. There are multiple ways to do this. For short-term investors, if you open the Moomoo app and go to Markets, then US, then scroll down to Featured List, High Dividend, you'll see that Moomoo has this feature that allows you to filter through different criteria to find the most suitable high dividend stock for your investment. By tapping the top right filter button, we enter the filtering criteria page. We can, for example, specify the dividend yield and market cap so that we get a list of more stable and established companies. Here, I'm going to enter a dividend yield between 5 and 10%, and then a market cap between 10 billion and 3 trillion. There we go. I already see some familiar names. I can then tap into the individual stocks and go to their company, then Financials tab to conduct more due diligence on their financials. Check if metrics such as EPS, revenue, balance sheet, asset and liability, and cash flow are stable or within a reasonable range of growth. Now, as I said earlier, what I like to do is long-term investing. For this, I use the app to study Dividend Kings and Dividend Aristocrat stocks. Some of my favorite stocks for long-term investment are Abbott Laboratories, AbbVie, Target Corporation, NextEra Energy Incorporated, and Atmos Energy Corporation. To simplify things, I often look at what the big gainers like Vanguard, BlackRock, and JP Morgan are investing in. You can easily do this using the Moomoo app. In the top right corner, you'll find a search button. Type in ABT, which is the ticker symbol for Abbott Laboratories in our case. Once you've clicked that, you'll access the company profile. In this section, you can click on the company and see how the company and its stock are performing. You can also view their year-over-year revenue and EPS targets and whether they've beaten them or not. Most importantly, you can also see the analyst rating of a stock, which in ABT's case is a strong buy. Scroll down a little, and you'll see the reasons why. The company valuation gives you an idea of the why. You can see that ABT has a price-to-earnings ratio of 38.02. This ratio indicates the company's valuation compared to its earnings. However, you can also see how other stocks in the same industry are valued in this sector, which, in our stock's case, is 41.33. This suggests that ABT is undervalued and a good stock to buy right now. This approach is mostly used for short-term investing, but it can also help beginners choose a good entry point for their long-term investments. If you scroll down to the shareholders section, you can see that Vanguard Group and BlackRock each hold around 8.5% of this stock, which is a positive sign for long-term investors. There's another crucial aspect to consider when investing in long-term dividend stocks, and that's the company's history of paying and increasing dividends. You can conveniently check this in the app as well. On the same page of the company, all you have to do is scroll down to the end, and you'll find corporate actions. Click on Dividends, and you can see the entire history of Abbott Laboratories' dividend payments. You'll notice that they've been consistently increasing their dividend for the last 10 consecutive years. Additionally, you can calculate the average dividend growth for ABT stock using this formula. We can see that last year they paid $2.04 in dividends, while 10 years ago they paid 56 cents in dividends. Plugging these values into the formula, we calculate an average dividend growth rate of 13.8%. Using the same formula, we can calculate the average stock price appreciation. The current value of the stock is $112.74, and 10 years ago it was trading at $39.40. Plugging these values into the formula, we get an average annual appreciation rate of 11.09% for ABT. So now that we have all the values we need, we can calculate the future projection of the stock. We have a current dividend yield of 1.95%, dividend growth rate of 13.8%, average annual growth rate of 11.09%. Putting all these values into our dividend forecaster, we can see that if you invested $10,000 in this stock and reinvest your dividends, it will be valued at $11,304 by the end of the year. In 10 years, your investment will triple to $34,845. After 20 years, it'll be valued at $128,857. From here, you'll really be able to see the compounding effect. Check this out. Thanks to the dividend growth and appreciation metrics of this Dividend Aristocrat stock, after 30 years, this stock has the potential to grow your $10,000 investment and reinvested dividends to $514,772, paying an annual dividend of $18,902 or $1,575 per month. In this entire timeline, ABT has the potential to add $504,772 to my investment, with capital appreciation accounting for $380,759 and dividend reinvestment contributing $124,013. Same is the case with our other stocks: AbbVie, Target Corporation, NextEra Energy Incorporated, and Atmos Energy Corporation. To give you guys some context, here's what you can expect from the other stocks that I had previously selected. I've already calculated the dividend growth and average annual share price appreciation for the other stocks to save you some time. It looks something like this. Now, if you put these metrics into the dividend calculator, you'll get these values. From this table, you can see that every stock has performed exceptionally well in terms of future projections. However, the top performer for my portfolio will be AbbVie, which has the potential to add $1,232,145 and pay an annual dividend of $52,359, equivalent to $4,363 per month. This brings us to the next very important step. Anyone who looks at this table might be tempted to invest all their money in AbbVie, given its excellent future projection. However, that's where beginners often make one of their biggest mistakes: not diversifying their investments. No matter how discerning you are in selecting stocks for long-term investment, one thing is certain: there's no guarantee that these stocks will perform as projected. Markets, sectors, and stocks can be unpredictable. For example, if you invest only in technology stocks and the tech sector faces a downturn, your entire portfolio could be negatively impacted. By spreading your investments across different sectors, you can buffer against such sector-specific risks. So the next best solution is to create a portfolio of your best selected stocks. A good starting point is to begin with 5 to 6 stocks and consider expanding to 12 to 15 stocks for your portfolio. Remember, you don't want to over-diversify your portfolio to 30 or 50 stocks, because then you won't be able to keep track of your investments if they're divided among 50 or 100 stocks, so keep it simple and manageable at the start. So if I were to create a portfolio of my selected 5 stocks, it would have an average dividend yield of 2.91%, a dividend growth rate of 11.47%, and an annual value appreciation of 10.92%. Based on these metrics, if I invest $10,000 in this portfolio, after 1 year, my portfolio will be valued at $11,384. The same portfolio after 10 years will triple to $36,780. Fast forward another 10 years, and in 20 years, it'll be valued at $137,275. Finally, after 30 years, it will balloon to $520,351, paying an annual dividend of $15,524, or roughly $1,294 per month. While we didn't quite reach the $1 million mark with this portfolio, we've significantly increased our chances of reaching a valuation of $500,000. But there's also a way to increase your chances and get closer to that $1 million valuation. For this, all you have to do is add $100 to your portfolio every month. And after 30 years, your portfolio will have a valuation of $959,537, paying an annual dividend of $28,591 or $2,383 per month. Now that you know the best configuration for your portfolio, all you have to do is replicate that portfolio in the trading app. In Moomoo, it's simple, but for this you have to switch to the desktop app because as of now, there's no option in the mobile app. However, you can create a portfolio in the desktop app. Recently had a talk with them, and they're rolling out this feature to the phone very soon, so keep an eye on that. Here's how you can easily create a portfolio using Moomoo. After you've deposited your initial investment, click on Portfolio on the left section of the app. It'll take you to the Create a Portfolio page, where you can track all your portfolios. To make a new portfolio, click Create and add a portfolio name. For example, JMA Dividend Stocks. After you've created the portfolio, you can directly select your stocks and add them to the portfolio. Then you can choose how much of your investment each stock should hold. Since I'm assuming I'm investing equally across all the stocks, I'll allocate 20% to each stock. Up until now, we've focused on dividend stocks, but the same principles can be applied to exchange-traded funds. And for those interested in short-term trading, potentially, you can test your strategies in the futures market or the cryptocurrency marketplace. No matter the long-term or the short-term strategy, guys, pick up those free stocks by clicking the link in the description. It's a pretty solid deal. Give the app a try, and if you don't like the app, you can always just take it off. Also, check out our video on 6 buy and hold forever dividend ETFs.